think I know most of you, but I'm Chris Van Hart, one of the wealth advisors here at Advent Partners. And we let Jim and Jamie have the day off. So they've been doing these quarterly updates with you for years. And so we've enlisted some help from our friends to present to you today. And so I want to go ahead and introduce them to you. But again, Chris Van Hart, I think most of you, if not all of you, know Jeremy, one of our other advisors here. And then Lindsay is our marketing manager. You get a lot of communication from her, and she makes all of this run. So I appreciate you keeping her informed and enjoy the time with us. So we have two friends from one of our research partners at BlackRock. We have Charlie Fagan, who's our main contact with BlackRock. He works with our investment committee. And then we also have Nick Morales, which this is sort of a unique opportunity for us. He's having a sort of farewell tour of the United States. He moves in about a month to Hong Kong to head up a program there for BlackRock. And so we didn't realize that when we were setting all this up, that we were sort of hosting his farewell tour. But he made the trip from New York City this morning over to Philly to meet Charlie. And then they came over, and fortunately the train delays didn't keep them from us. We were a little anxious at a few minutes, but anyway, I want to turn the time over to Nick. He's going to present an update on the markets. And as he mentioned to me, like to have this interactive. So I'll let him sort of explain how he wants that to occur. But without any further ado, Nick.
Thank you very much. It's a pleasure. Thank you all so much for welcoming me to such a beautiful part of the country. It was a gorgeous drive up. I love being over here. This is actually my first time in Gettysburg. So I'm hoping afterwards, Charlie and I can go take a look at the battlefield and see everything. As was mentioned, if you have any questions, we're going to be going over a lot of stuff, macroeconomics, markets, the whole 9 yards. If you have any questions, any points of clarification, anything along those lines, please, shout, raise your hand, whatever it is, please let me know. I'm more than happy to go and either dive a bit more into it, answer your questions regarding it, or explain it maybe in a different way. And so hopefully it will be helpful. I really want to, especially at the end of this hour, many of you folks to come out with feeling a bit more confident in what's going on in the US economy, what's going on in the global economy, but also making a bit of sense of what's going on in markets, how this impacts you on a daily basis, and also in your retirements, in your actual accounts themselves. So please, again, any questions, don't hesitate to shout, let me know. So the agenda for what we're going to be doing today, we're going to keep it fairly simple. So first, we're just going to start with the mid-year check-in, what we've seen in the first half of the year and what's been driving the economy and also markets. Then we'll get into more what we're looking at with the US economy, what we're seeing. And then we're also going to be talking about what the Federal Reserve is doing in response to these things. And you've probably seen this a lot in the headlines with Federal Reserve Chair Jerome Powell and a bit of a spat between him and Donald Trump, what that looks like. We can get into your questions around there, but I really want to go and again, come away with maybe a bit of better understanding of what this actually means and its impact, and then what it means for portfolios, what it means for what your friends here at Advent Advisors are going to be doing for you within your portfolios. So this is more just a simple point, which is one of the things that we've seen, especially in the post-pandemic recovery, is that we've seen a lot of cash being sitting on the sidelines. What this effectively means is that many folks are putting money in accounts, but they're not necessarily either investing it or spending it. So we see this huge rise, especially after that 2020 period, in which we go and see a huge accumulation in cash. Now, the primary reason for this is that when we go and look towards accounts. If you go and think about what you're earning, for instance, within your checking account, for many of you, hopefully, it's probably risen to a certain extent, or what you can go and get from a simple money market fund. And that's because the Federal Reserve went and raised interest rates in response to inflation coming out of the COVID pandemic. So we've seen this huge accumulation in cash. But despite this huge accumulation in cash, one of the things we're talking a lot about at BlackRock, and I'm sure you've heard it from your advisors, is just the fact that when we have money sitting in cash, it's not necessarily working for us. When we put it in bonds, when we put it in stocks, it can actually go and work, and we can go and help build wealth in that way. We can create wealth in that way. But we're seeing a lot of cash sitting on the sidelines. And so this is kind of an underpinning of one of the things that we're talking a lot to clients about, whether it's folks like you guys, or whether it's folks on the institutional side, big foundations and endowments. We're seeing the same sorts of trends, which is that there's a lot of cash sitting on the sidelines that's not necessarily being deployed. Now, in our opinion, we think this is a missed opportunity. If you go and look at the graph on the right, what you'll see is that what you can go and get from a yield. So how much is it returning to you? On cash, you're getting about 4.4%, but in the rest of the market, if you go and put it in, for instance, bonds, or if you put it in stocks, we think you can get significantly more returns with not too much more risk. And as a result, we think this is a big missed opportunity that many folks are still having cash on the sidelines overall. Now, this matters a lot because what we've seen, especially from the market in 2024, but also this year so far, despite all the volatility, despite all the uncertainty around what the Trump administration tariffs will look like, despite the worries going into the year that we may be in a recession, we've actually seen pretty solid performance so far from US stocks, from international stocks, and also from our fixed income from bonds as well. Now, there is a bit of divergence, which you go and see in this graph, especially on this right side. You can see those orange bars, and then you can see the yellow bars. The orange bars are the lead up into Liberation Day. So when Donald Trump went and announced his tariff plans, you can go and see how markets reacted. If you just go and look at, for instance, US stocks were down 15% to go and start the year coming into April. Since then, however, we've completely recovered that. We're now up 25%. It's been 25% up since. And that leaves the market around 7% up on the year. So we've seen this huge amount of volatility as the new administration has come in, as policy announcements have come in, that have led to a huge repricing one way or the other. Now, one thing I'll go and get back to is this is one of the reasons why we go and tell folks that no matter what's happening, whether it's a certain administration or whatever worry there is, that staying invested is the most important. Because let's say, for instance, the Trump administration, you went and heard that they were announcing these tariffs on Liberation Day, and you took all of your money out then, you would have missed that 24.9% run up in the past couple of months. That would have effectively recovered where you were before. This is one of the things we like to talk about at BlackRock, and again, I'm sure you've heard it, which is that staying invested is the most important thing. It's about time in markets. And again, the primary reason being is that despite the volatility, despite everything that's happened over the first 6 months of the year, we're still in a pretty solid place. That kind of leads me to my second point that I also will touch on a bit further, which is where the US economy is, and that the US economy, despite what some people may think, is actually fairly resilient overall. We continue to do well, but we've had a pretty solid year so far, despite the volatility. And this is really bringing that point to home, is that stock market volatility, we have had more days this year than we typically do, in which the market's been up more than 1% or down more than 1%. And that's, again, a large part of a bit of uncertainty around what it actually looks like from a corporate perspective. If I'm a company, for instance, such as Apple, and I'm manufacturing iPhones to go and sell to all of your grandkids, then what I'm doing is I'm trying to go and figure out what the supply chains actually look like. I have to go and navigate that policy environment. And if that starts to go and change on a daily basis or even a weekly basis, I don't know how much it'll cost me to go and import these electronics. That goes and hurts my bottom line. That makes it a lot more difficult to plan further expansion. And we've seen that play out in the market. So far, year to date, We've had these plus or minus 2% days. We've had 12 of them. Usually we only see that during periods in which we have an actual recession. For instance, back during the global financial crisis around 2008, or during the COVID pandemic, when there's very high uncertainty. We usually don't get this around policy announcements. So this year is unique in that respect. With that being said, we do think that we're in an environment where there is still opportunity to go forward. What we go and see this year, especially in the stock market so far, is that strength begets strength. The biggest companies are continuing to go and perform quite well overall. Now, the primary reason for that is that these companies, think of the Amazons of the world, the Metas, the Facebooks, the Apples of the world, they continue to go and produce good products. They continue to go and spend on successful CapEx that has an ROI. And as a result, these large companies who are under a lot of pressure to go and start the year, especially around the policy changes, as we continue to go and approach a more certain policy environment, again, especially around the trade front, they're starting to go and come back in a big way. And what that means is that the earnings that these companies have been bringing in have been really strong so far. Not only in 2024, 2023, and 2022 did we go and see this really strong earnings strength, but we're seeing it go and continue. Just to go and draw attention, I'm going to try this feature, so I don't know. Oh, I don't think it's working.
The top button.
It's right. On this right graph, one of the things you can go and look at is we have the Mag 7. These are the top 7 companies in the US in the S&P 500. These are the biggest, largest companies that we all know and love very well. Their earnings growth in 2023 was 25%. It's absolutely massive by any means. Let's go and put some numbers to it. I think the number for Microsoft just most recently was $80 billion in revenue. That's an incredible amount of money that they're bringing in. Their earnings growth in 2023 was 25%. It moved up in 2024 to 37% earnings growth year over year. It's a huge amount of money that they're bringing in, and they're continuing to go and do so. While the rest of the stock market, and this is the divergence that we're really seeing within the stock market, is that when you think towards companies that you traditionally associate with the stock market, maybe think like McDonald's, IBM, PG&E, so more of those consumer staples, consumer discretionary names, their earnings growth has been very minimal. It was negative in 2023, it's positive, but only about 4% in 2024. And so what we're seeing is these largest companies, the companies that continue to go and drive earnings, are continuing to go and do so in 2025. And that's one of the big takeaways that we've heard from just this most recent earnings season, is that the largest tech companies are continuing to go and rake in profits, while the rest of the companies are, they're all right so far. They're having some earnings growth or flat earnings growth. And a large part of that just has to do with margins at the end of the day. For instance, if I am Meta and I own Facebook and Instagram, and I'm selling advertisements, my platform, Facebook, Instagram, is already built out. So my expenditures on that social media platform aren't necessarily very high year over year, but I can still sell advertisements, and more people are advertising on these platforms. However, if I am, for instance, Garmin, and I am building actual electronics, I'm importing different parts of a GPS system into the US, I have to go and do that on a quarterly basis. I have to bring this in. So I'm very much affected by changes in those costs associated with those goods. My fixed costs are going to be moving higher. That's why those companies are struggling a bit more than these large cap tech companies that we see continuing to perform well. Now, with that being said, when we look towards the rest of the year and we look towards 2026, we do expect a bit of a normalization. We expect those large cap tech companies to go and start not having as much earnings growth. It's still quite high, it's still 15%. And we expect those other companies to go and start to go and perform a little bit better. Now, what that means is that for 2025 and 2026, you start to go and see those companies, the rest of the index start to move up in earnings growth from 4% to maybe 8%, maybe 10%. A large part of that, however, is very much dependent on how the US economy continues to go. Those large cap tech companies, they continue to do well, usually throughout every environment, but especially for the rest of those companies, a large part depends on how the US economy is doing. And that's where, when we look towards the US economy, this starts to really matter. Now, what we went and saw in Q1 is that we went and saw negative GDP growth. Now, a large part of that number, if you all remember, is actually a lot to do with tariffs. When we go and break down GDP, we have four components effectively. We have consumption, we have investment, we have government spending, and we have net exports. Now, in anticipation for Donald Trump's tariff policy, you saw a lot of companies go and front run this. They imported a lot of goods. As you can imagine, that means your net exports component is very negative. So even though you have high consumption, even though investment's solid, even though government spending is solid, the net exports component was deeply negative, and that brought us down to that negative 0.5%. So it's not necessarily a worrisome number. However, what you can go and see from this is that from kind of that 2024 Q2 onwards, we are slowing a little bit. And this is what we can expect. We did go and expect this in 2024, and we continue to expect it in 2025. Now, the reason being the US economy is very large, means that at the margin, we can grow at about a 2% rate every year. The 2% is sort of our target, and that's sort of our baseline. That's what we think we can achieve. That's the right amount of output. We don't really want to be growing too much faster than that. That means things are heating up. That means inflation is possibly rising, and we don't want to be going slower to that. Slower than that means that, maybe we're losing jobs or something along those lines. So our expectation for 2025 is around 1.5%. Now, that's a bit lower than 2%, but it's still very manageable. And a large part of that is a bit of uncertainty around, again, what the trade policy looks like for the US economy, but it's also a cutback in government spending. Government spending boosts GDP. If you get a cutback in government spending, that will go and lower GDP. If you have an uncertain trade environment, investment in the United States, especially from foreigners, is going to go down. So that lowers your GDP projection a bit. Your net exports, are not going to be as negative considering the trade policy. That maybe helps boost GDP just a little bit as well. So we have these different components that are rebalancing in different ways under this new administration. But what we're seeing so far is that we think it will hold up pretty well. We don't think we'll go back to 0% GDP growth. We think 1.5% is probably about where we want to be. Now, the graph on the right is what we call non-farm payrolls. It's how many jobs are we adding each and every month. And this has been in the news a lot, as I'm sure many of you have seen, because what we went and got was, especially these past couple months, where we were averaging around 145,000 new jobs on a monthly basis. Those were revised significantly down to 14,000 for the previous month, and I think it was 19,000 for the month before. Now, I have to say a couple things on this because this has been in the news quite a bit, especially with Trump firing the head of the BLS, the Bureau of Labor Statistics. So when we look at these non-farm payrolls numbers, the first thing that you have to remember is that the margin of error on these calculations is plus or minus 125,000. So when we get that initial number of 147,000, it can either be 125,000 more or 125,000 less. Now, there are reasons for this. The primary reason being is that this is survey data. So for instance, if I go and send out a survey to a bunch of businesses for, the month of July, and I'm getting in responses over the course of August, and then I'm looking to go and release the data. I'm getting in a certain number of responses, and then I have a model that goes and tells me, hey, here's actually what, based on these surveys, if you go and project this across a broader economy, this is what it looks like. So based on those survey responses, as we all know with polls, they aren't necessarily the most representative of everything. So we go and get these survey responses, and then we go and project out. And we go and say, okay, most likely it's going to be around 147,000. In any other environment, that works pretty well. We have a couple extraneous situations that are leading to it not working so well. And in this case, in a very glaring way. The two primary reasons I'd say for that is that since 2020, since the COVID pandemic, we've seen response rates on these surveys go down. Before we were at about a 70% response rate. Now we're closer to a 40% response rate. That is an issue with the underlying economic data that we go and use to go and project out what the economy is actually doing in real time, and also what we think it's going to do going forward. The second thing is then you also go and get a bit of a selection bias. If I'm a company and I'm doing well, I am more likely to go and respond to a survey in a timely fashion. I'm more likely to, fill it out really quick because I have the time to. Things are going well. I'm not worrying about a bunch of other things about what my tariff supply chain impacts are, all of those things. So you get a bit of a selection bias in there in which the early respondents in which the model is based off of are the companies that are doing well. And then as more surveys come in, those are the companies that are, oh, we just got to this, we just opened this piece of mail and we are just getting back to it now. And that's how you get these huge downward revisions like we went and saw. Now, one thing to go and keep in mind with this is that one of the things that we do go and see in the trends of data is that as the job rate is going down, so you're adding less and less jobs every month, you're more likely to go and undershoot. And that's because that's where the trend is, because of these biases as I want to talk about. When you're going up, when you're adding more and more jobs every month, you're more likely to get revisions higher. So the trend really matters. And as you can go and see, the trend has been down since 2024. And so that's how we're getting these months in which all of a sudden there's only 19,000 or 14,000 jobs added. And I know that's a lot. Do we have questions? Yes, sir.
Yeah, so BlackRock is a big deal. So I'm familiar with agriculture, very familiar with USDA. So it's the same thing, USDA reports, and so farmers are very cynical. They don't trust the reports, but there are a lot of other consultants similar to BlackRock that do surveys, and so they all get compiled. And so when I read so-and-so says, well, the carryover is going to be so much, but USDA says that. But when that USDA number comes out, that's still what moves the market. So my basic question is, does anybody else track this for the jobs market?
Yes. So what we go and use a lot at BlackRock is not necessarily the official data. What we use is what we call alternative data. And what we go and look at is, for instance, Indeed.com.
Yeah.
Great hiring site. We go and look at job postings on Indeed.com. And what we can do is we can go and build a model based off those job postings and also a couple other sources. And we can go and say, this is most likely how many jobs were added. Not only how many job openings there are, but then you can go and look at the rate at which there's a turnover. How long have those job postings been on the website? How quickly are they getting filled? And then we go and build our own alternative model that goes and suggests what we're looking at. And this is the primary reason that, we've been suspecting this slowdown. I think, for instance, the most recent number was 71,000. If you looked at the general economist forecasts, they were still looking about 140,000 jobs to be added. If you looked at the sell side firms, for instance, what we were talking about, we were looking closer to 70,000. And the reason being is that we're using that alternative data, just as you are in your practice, of being able to go and model that out. And that's one of the drawbacks of this, is just the fact that this gets huge headlines because it's coming from the Bureau of Labor Statistics, and the data that they're working with is not necessarily the best. we have the ability to go and bring in other data sources in order to estimate what we think is a better number at the end of the day. Yes, sir.
Just as an example of Indeed, does it lean more toward professional, high skill type things, or is there a representative sample that's usable for labor manufacturing in their data?
Yep, this is a great example. It 100% skews towards traditional white collar jobs. You're not necessarily going to get the same when it comes to labor and manufacturing. The primary sources that we go and use on the labor and manufacturing front is that net immigration actually goes and proves to be a pretty good reliable indicator of what it looks like on labor or manufacturing front. And then I'd have to get back to you on the second one. There's two that we really go and use on this front, but it doesn't serve as a good predictor for what you go and get on that side of the equation. I think the other thing to go and say there is that when we look towards the US economy and where the jobs are primarily located, again, it's primarily on the services side of the equation, and it's primarily on the white collar side of this situation. So on the manufacturing side, it's just a significantly less portion. So when we look at it from a broad economy perspective, the numbers aren't really changing much. They're not meaningful in the sense of the broader US economy quite as much as we want to go and be able to predict the white collar growth. Now, what we really mean there is that, and we went and saw this actually under Trump's last administration as well, which is, for instance, you went and saw a huge focus on US manufacturing and steel tariffs. And the whole idea was to go and bring jobs back to steel manufacturing here in the US. When we saw the number of jobs that were actually added off the back of that, I think the numbers wouldn't put it at something like 70,000 or something along those lines, which in an economy that's typically adding about 130, 140,000 jobs a month is really just a drop in the bucket at the end of the day. So I think for us on the manufacturing, construction, that side of the equation, again, net immigration is probably our best predictor of what that actually looks like. Any other questions? Because I know this one's been very much in the headlines recently, so I just want to make sure that you all understand it as best you can. Okay, so we see growth slowing. We see the labor market starting to move slower. That's not necessarily a bad thing. Again, when we look towards what our long-term run rate for adding jobs every month, before COVID, for 2020, it was actually around 120,000 jobs per month. So even at an average of around 140, we're still sitting above that. And you can think of these things as kind of like a pendulum. If you go and add a lot of jobs in 2024, then you're probably not going to add as many jobs in the coming quarters. So we can think of it as starting to go and slow down and moderating. Now, what the Federal Reserve, Jerome Powell, and all of those folks are really focused on is whether or not that pendulum is swinging too far. Whether you're dipping below that average line and you're kind of coming back up towards it, or whether you're going down further. That's the biggest question out there at the time. Now, really quickly before we get into the Federal Reserve, just quickly touching on inflation, because this is a big one that we're also watching. This is one of my favorite graphs, primarily because it goes and breaks down the drivers of inflation for you all. So you can see that we go and break it up into four main components, which is services inflation, goods inflation, food inflation, and energy inflation. Now, as we can go and see, if you go and look post-COVID pandemic, first thing you need to go and see is that what's driving that bar up, that black line to our peak of 9.1% inflation in June of 2022, is you start to see energy and goods inflation. So remember, when we're all sitting at home and you want to go and buy particular goods because you're sitting at home, you're spending a lot of money on goods. Spending money on goods leads to goods inflation. We also saw the energy inflation component of it. That started to go and play out. That's what really drove the inflation spike to 9.1% in 2022. Now what you can go and see in 2023 and 2024, you see those yellow bars start to creep up. That's services inflation. What we mean by services inflation is how much you're spending at restaurants. Now, when we look towards service inflation, what drives that? What drives the price of your food at a restaurant? It is the cost of labor and to a certain extent, the cost of food. So as we go into 2023 and 2024, people are spending less on goods. They're not spending, they don't need to go and buy all the things that they went and bought during 2021 and 2022. They're spending more at restaurants. They're going out more. They're spending more on services. And at the same time, we have a relatively tight labor market because we're not all going back to work in the same way as we were before. As a result, you start to go and see services inflation go up. And it really peaked in mid 2023 is really when it saw it peak. And now steadily it's coming back down. Now services inflation is really difficult to go and bring back down. You can see that the decline in services inflation is really gradual. And that's what the Federal Reserve has been fighting. The primary way you go and combat services inflation is you raise interest rates. That slows the economy down and it slows the pace of the move higher in wages. So as I imagine you all can remember, is that back in 2022, 2023, you're looking to go and hire, for instance, someone, a waiter for a restaurant job, you know, $15 an hour wasn't cutting it anymore. You had to pay them $20 an hour. Maybe you even had to pay them $25 an hour. That's the services inflation that actually we see show up in the data. Now, fast forward to today, you don't have to go and pay them necessarily $30 an hour now. You can only raise that price by maybe, you know, $26, $27 an hour, and you can go and fill that job. So that combination of a tight labor market, not much labor supply, coupled with the aspect that people were raising wages, leads to that services inflation component. And that's super difficult for the Federal Reserve to bring down. If you think about the Federal Reserve raising interest rates, that makes homes more expensive, that makes auto loans more expensive. Anything where you're borrowing to effectively buy a good, to buy something real and tangible. It's really easy by the Federal Reserve raising interest rates to go and bring those prices down. It's a lot more difficult for them to go and impact services inflation. And so that's the steady decline that we're seeing. Now we're at around 2.4%. Now what we're closely watching, what we're a bit worried about, and you go and start to go and seeing the most recent prints, is that we're seeing goods inflation start to tick higher. Right now, it's constrained to a couple groups, primarily sports equipment, electronics, and furniture. Think of the things that we heavily go and import from other countries that we're not necessarily building here. Sports equipment, just think toys, things that you would go and get, you know, the soccer ball you're getting, we're not manufacturing here. We're starting to see it tick up in those key components by that amount that we're seeing in the tariff data. So as a result, we're a bit worried about that 2.4% starting to go and maybe accelerate a little bit more. Now, one of the things that the Federal Reserve's mandate is that they have two sides of their mandate, which is full employment in the US economy and then stable inflation. Now, the stable inflation aspect is not necessarily high or low inflation, but what they're looking for is 2% inflation. You want 2% inflation. That's good. You want some amount of inflation in an economy. That means it's growing to a certain extent. So as a result, we're not quite down to that 2% level that the Federal Reserve wants. That's why Jerome Powell and the rest of the FOMC has decided to go and keep rates relatively high for the time being. Is that we're not quite down to that 2%. The way Jerome Powell, the way we like to talk about it, is that they want to see the whites of the eyes of 2% inflation before they be willing to go and cut further and ease the policy rate. Now, when you start to go and see in the data that there's this goods inflation starting to go and come into the US economy because of the tariff policy decisions, you're going to hold off. You're going to wait a little bit longer just to go and see, make sure it's not showing up in the rest of the economy. That's the part that the Federal Reserve has primarily been worried about. But remember, they have two sides of their mandate. They have the inflation side, but they also have the labor market side. So all of a sudden, when those revisions of 140,000 jobs are looking more like 14, 19,000 jobs, now all of a sudden, the Federal Reserve has to worry about the other side of their mandate. When the economy is good and we're adding a bunch of jobs, all they have to worry about is inflation. Now, all of a sudden, we're starting to go and worry a bit about the job side. We don't want unemployment to go and tick up past the 4.1% rate that it's at right now. We don't want it to get up to 4.5%, 5%, because that's actually materially damaging to the US economy and to the people of the United States. So as a result, you start to go and see what we call dissents. Two people on the FOMC, Bowman and Waller, both went and said that they wanted to go and cut rates this past meeting. Primary reason being is that they're worried about the labor market front more so than they're worried about the inflation front. As with most things for human beings, we oversubscribe to the most recent thing. Jerome Powell and the rest of the FOMC had to deal with 9.1% inflation, so they're worried about inflation coming back. And then they look at it from a historical basis. Famously in the 1970s, we had the inflation scare. Inflation ticked up quite heavily. The Federal Reserve went and raised interest rates in response, brought inflation down. But then they went and cut rates too early, and inflation spiked back up. That led to an environment in which famously amongst Federal Reserve governors, you don't ever want to replicate. So what Jerome Powell is dealing with is legacy defining things. This is how he'll be remembered. Do you want to be remembered as the Fed governor who let inflation go back up again after it peaked at 9.1%? He doesn't want to be that person. But at the same time, you also don't want to be the Fed governor who went and drove the US economy into the ground. So that's the balancing act that they're playing with right now. Any questions on those dynamics? Yes, sir.
Quick question. And as far as the tariffs go, where do you see the lag time? Assuming they stabilize what the tariffs are, when it shows up in that data?
This is very dependent on the sector and industry. I know this is not the best answer, but it really does vary. And the primary reason it varies is because as we went and saw in that Q1 data, that negative 0.5%, what that meant was that we had a lot of imports. So people were bringing stuff into warehouses in order to get it front run the tariffs. And so as a result, the sectors and industries in which people went and front loaded, brought stuff in, had a large amount of inventory, tariffs are not showing up as quickly in those areas. But for people who didn't necessarily do that, or for sectors that weren't able to go and do that, we're starting to go and see the impact start to go and come on a 1 to 2 month basis. And the primary way in which it shows up is it can show up in two ways, in which it can go and show up as margin compression. So if I'm a company, my margins just got lower. My fixed costs move higher. The amount I'm selling it for is going to stay the same. And I'm going to take the hit. And so you're starting to see it places there. And then in other places where you're seeing companies like, I want to keep the same margins, I want to keep my 5% margin, you're starting to go and see it there. So it is very much dependent on who is able to go and front run the tariffs to a certain extent and build up an inventory. One of the things that we're going to see in the back half of the year, it will very much play out in the data, is that inventory build that we had in Q1 has effectively been winding down, and we won't be able to go and build that inventory quite the same way again. So in the second half of the year, we'll be able to go and see very clearly where tariffs are starting to impact. But typically it's going to be on a 1 to 2 month lag. And the primary reason for that is because, especially if you're ordering stuff from abroad, it takes about 45 days to go and ship it across the Pacific Ocean to go and get here before it's actually in a store and you can go and sell it. Now, again, companies have different ways of dealing with this. Some companies are willing to go and take the hit to their margins. They're willing to go and say, okay, we had a 5% margin, but we'll accept a 3% margin because we want to keep the price the same. And this is coming head on with the aspect of many people no longer want inflation to go and show up in their prices. We're tired of it. Our balance sheets are in a pretty good place. Household balance sheets are in a pretty solid place, but wages are they're not growing quite as fast. So my ability, if you go and raise prices on that, I'm not going to be as readily able to buy it. So as a result, they'll keep prices the same. That's showing up in some places, but not in all places.
I would argue that's a short-term solution.
It is for the time being. Now, one of the big things that we've seen is, you know, what we go and talk about is what's the effective tariff rate? What we mean by that is if we go and look across all goods that we go and import and go and sell here in the US, what's the tariff rate on those? Effectively, since the 2000s, it's been around 3%. So 2 to 3% is kind of the level that we're at. And that comes down from a high of the Smoot-Hawley tariffs back in, you know, before World War II. It's been coming down ever since. And then we go and get around 2 to 3% effective tariff rate. The original tariff proposals, what we saw on Liberation Day, what really worried most of the US economy, markets and stuff, was the aspect that it may be a 25% effective tariff rate. So pretty much all goods go up by 25%. Right now, we're looking towards more of maybe around a 13 to 15% effective tariff rate, which is still a very material change from the world in which we were in before. That will go and continue to erode household balance sheets. Now, we've seen coming out of the pandemic that household balance sheets are actually in a pretty solid place. People were able to go and pay down debt in many ways. People were able to go and save. We see that cash on the sidelines, that aspect of it. People's wages went up at the same time. But, you know, that's slowly coming down. It's not as strong as it was. And now all of a sudden you're getting a bit of a price increase. And that drag, those dynamics playing out in the US economy, we think especially in the back half of this year, you'll really start to go and see the trajectory of what that actually looks like. We don't quite know yet. And one of the primary reasons we don't quite know yet is one of the things that, despite the headlines and what you go and see, there's a lot of exemptions. So for instance, on the electronics part, you know, if you try to go, and I think famously, if you try to manufacturing a iPhone here in the US, you know, the cost of the iPhone is something like $5,000, something to that tune. It's prohibitively expensive. So you see exemptions for the chips and components within iPhones. Now that does go and benefit larger corporations who are able to navigate that, who are able to go and lobby on that behalf.
You probably aware of this. Well, my son manages, or I can't name, the British company makes medical devices. He manages plants in Slovakia, Mexico, and so on. And I asked him over the weekend about the tariffs were exempt.
Yep.
And so that's probably a good thing from a health standpoint, but it seems absurd to me.
Yeah, so there's lots of exemptions. So the way this actually plays out in the data will be very different. I think most recently, one of the best examples that I have is that the Trump administration would announce copper tariffs. And we saw the price of copper go and spike. I think it was like 15% or something along those lines. And then a week or two later, they went and announced what the actual policy would look like. And they exempted most copper, refined copper, which is what we primarily import. We're not necessarily importing the ore itself. So as a result, like the price went dropped, I think 20% in a single day. And so that's the volatility that we're seeing. You know, we're come back and we're pretty much where we were, where we started, but there's volatility in the meantime. And that's really playing out in markets. So part of this reason, all of this inflation dynamics, this growth story, this labor market story, what it means for us is that the Federal Reserve most likely is going to go and lower interest rates, but they'll go and do so slowly. They're going to want to see the data coming in, and they want to be confident on the inflation side that it's not coming back. And they want to be confident on the labor market side that it's not necessarily falling off a cliff. So as a result, what we go and expect for the rest of the year, September will be a really important time. This will be in the headlines. You'll see it. There's a September FOMC meeting. We expect a 25 basis point cut. Come September, we expect another 25 basis points come December. There's lots of calls for them to go and cut more, to cut maybe 50 basis points in September. Now, one of the big things I will go and say on this front, just as a FYI, when we think about the Federal Reserve cutting interest rates, we love to hear it. It takes about 6 to 12 months is the typical lag for it to actually impact the US economy. So if they go and cut by 50 basis points in September, you'll go and see a bit of a reaction in markets. Markets will want that. Will go up. But when we actually see it on the downstream impacts, it's most likely going to be further down the road. So it's tough. They're in a difficult situation. They have to respond to real-time data, but they also have to be thinking ahead about what that data means going forward. Now, one thing that we've seen, especially from the Trump administration, is the notion of having a weaker US dollar. Now, within investment accounts, this matters a lot. If I'm a US investor, I have US dollars and I'm investing it in European countries, a weaker US dollar actually means that my investments are doing better. Because when I go and convert that from a US dollar to a euro in my investments, and then I'm converting it back, a weaker declining dollar means that international investments do a whole lot better than what we're doing stateside. One of the things we talk about often, and again, I'm sure you heard it before, is this is why diversification matters. This is why within a traditional 60-40 portfolio where we're 60% stocks, 40% bonds, that 60%, we have some allocated to the US and we have some allocated internationally. So declining US dollar matters a lot in that way. That's what this graph on the right is showing. This is year-to-date performance, that big orange bar that says 18.6. That's if you're a US dollar investor, that's your return on investing in international stocks. Now, if you hedged that, in other words, you went and took out the currency component of it, your return was only 8.4%. So the diversification benefits of something like international stocks matters a whole lot in a weaker US dollar environment. Now, there's other policy things that are guiding markets. This is our general cheat sheet that we have for most of this. As you can see, tariffs, lower growth, higher inflation. Immigration, most likely lower growth, higher inflation. If you go and address the deficit, which we haven't seen in a meaningful way quite yet, growth can possibly go higher, but then the inflation front, maybe a bit higher. Taxes, as we went and saw, maybe it can go and help growth in some way. Mostly the taxes that we went and saw were a continuation of Trump's original policy. So those were baked in already. They aren't necessarily pushing growth. Deregulation that can also possibly help. So there are things that they can do from a policy perspective to continue to help the economy, but this is your general cheat sheet on what that looks like overall. Any questions so far? I know we went and covered a lot on the US economy. I want to make sure that everyone feels comfortable with what we have covered. Yes, sir.
Well, we opened up talking about all this cash that's laying out there uninvested. What do you suppose is causing that, and what will cause it to go back into the market? With fixed income funds paying about 4% interest, that's not too bad an investment in uncertain times. What should I do with all that extra cash I've got laying around?
You should put it right in fixed income. And that's one of the things that we're talking about, is that you have a lot of this cash sitting on the sidelines, but we think there's great opportunities within fixed income to go and be able to do just that. Because your risk-free rate, so what you earn on a US 10-year government bond, is, right around that 4.5%. Within investment grade. So these are the best companies, they have strong balance sheets, they're going to pay back their debt. You can earn around 6%. Even in high yield, where companies is actually a better universe than it was back in 2008, for instance, their companies are still in relatively good shape. You can earn 8-9%. So we think there's plenty of opportunities for people to go and do exactly that. Now, one of the things we've been debating is a huge debate amongst investors at BlackRock is exactly your question, which is like, what brings them back? Because we've seen this build up. We've been saying, hey, it's a great time for fixed income. It's a great time for fixed income. And we're not necessarily seeing it go back. The primary reason is that people like to go and see if my money market fund that I'm putting it in earns me 4%, people are relatively content with that. So if you see those yields start to come down, then you see people start to go and maybe step into more risk. Usually people are targeting like 6-7% income, which if you can achieve with maybe just investment grade or something along those lines, or maybe a bit of money market and stocks, you can achieve that pretty well. Then like, I don't necessarily need to be investing all my cash all at once. So trust me when I say it's a big problem that we're trying to go and figure out and trying to encourage people to get that money off the sidelines. Yes, sir.
Similar vein, but more commercial. $4 trillion cap for Microsoft and NVIDIA recently.
Yeah.
We know they have a whole lot of cash. We know there's a big push to onshore manufacturing. Is there any evidence of them doing that, or are they still doing stock buybacks and playing it cozy and not doing the economy any good?
There's two things on that front. First and foremost, they're primarily spending that free cash flow on infrastructure for AI. You're seeing it in data center buildouts, and you're seeing it in purchasing of NVIDIA chips. So that's the primary way in which they're spending that money. In the 20, yes, huge. I think the number for the Mag 7 that we saw most recently is expectations around $450 billion in capital expenditures on AI specifically. So it's a lot of money is going into that space right now. They're spending a bunch of money on it. We went and saw it, especially late 2010s. You saw exactly what you're talking about, which is they put it towards share buybacks, boost their stock price in some ways. Now,
And CEOs.
yes, and CEO salaries. And so one of the things that we go and see going forward is that they're continuing to go and spend that money primarily on AI. Now, what does that actually look like when it comes to the US economy? This is kind of goes in the second point that I was going to make. We've done some really good analysis on when we go and see, especially the Trump administration and standing next to CEOs announcing deals on spending in the US, what's the actual amount that we see spent coming out of it? The typical rate when we saw it under the first administration was around 30 to 40% of that money was actually realized. So if someone's announcing $100 billion investment in, the US, you typically see around 30 or $40 billion actually invested over the course of it. We think that will probably be slightly higher this time. We think maybe you get to 60, maybe 70%. But one thing that you can say is that most likely it's not going to be that headline figure. And the primary reason is for exact issues that I think you can imagine, which is that we don't necessarily have the infrastructure, the energy infrastructure, the labor market to be able to go and support it. I think Foxconn famously went and tried to go and build a chip manufacturing plant in Arizona, and they had to scale back those plans because they literally just couldn't find the technical expertise in the labor force that they needed in order to go and even man the warehouse. So it becomes difficult in that way. Now, many of these companies are using a large part of their money on AI right now. That's where we're seeing the primary CapEx spend going at this time. Any other questions? So I know we're coming up on time. So what I do want to go and say, so we have all of this backdrop of US economy slowing, inflation, it's in a good place. We're a bit worried it might accelerate. Labor market is slowing. These aren't necessarily bad things, however. And we're seeing a Federal Reserve who's kind of sitting patiently for the time being, waiting for what might happen. Now, what does this actually mean for markets? As you can go and see, my first point was the one that I started with, which is we want to remain invested. And the primary reason being is that the US economy and stock market is very resilient. Companies, if there's one thing you can go and trust, is that companies are really good at protecting their profits. They continue to go and break in earnings. It's a bit of a skepticism of capitalism, but one thing you can say is that they're very good at that. So when we go and talk about investments, we want to go and remain invested. Companies are very good at protecting their margins and doing what's best for their company. So it means that we stay invested, but it also means we have a preference for those larger companies. We think the companies that get left behind are some of the small cap companies, the companies that aren't able to effectively navigate the changing policy environment, who don't have pricing power over their manufacturers abroad, who aren't able to go and necessarily pass on tariff costs. It hurts the smaller companies at the end of the day. So when we look towards markets, we want to go and remain invested, but we also want to look towards those large cap quality companies who have strong earnings. We think they continue to do so this past earnings cycle when it showed us exactly that. The second thing, going back to your point, sir, there's great opportunities within fixed income. During the 2010s, if you're a fixed income investor, you're earning 3, maybe 4% if you're lucky. You're earning 6% if you're stepping out into riskier parts of the market. Nowadays, your base level that you're starting at is 4.5%. So the opportunity within fixed income to go and actually earn real income is very real in this type of environment, in this policy rate environment. We think there's great opportunities within that space, and we think that goes and continues for the time being. So if you're a fixed income investor, it's a great time to be a fixed income investor. It's the best place to be right now. It hasn't been like this since before the 2000s, effectively. Now, the third thing, this goes back to my point around the US dollar, is that diversification matters in this type of environment. When we look towards stocks, we want to make sure we have a good mix of not only US stocks, but also international. Because US dollar declines means that your international holdings are going to outperform your US holdings. There's other ways in which we can go and find diversification. We think towards alternatives, we think towards different asset classes. There are many ways in which within a portfolio, you can go and have diversification. And it's more important, especially during times of volatility, to go and ensure you reach your investment goals, to have that diversification within your portfolio. I guess one thing I'll leave you with, I'll leave you all with. I grew up in Seattle, Washington. My daddy's a fisherman, so if you ever seen Deadliest Catch, that's what my dad did. And I remember, his whole thing, he's like, you never want to do what I do, going out on a boat for 3 months out of the 3 months and then be back home and going out on a boat for 3 months. He's like, it's not the best way to earn a living. He's like, you want to go work in, a place like BlackRock. And once I started working here, it was actually about a year or two in, I got a call from my dad's chief first engineer. And he was like, hey, Nick, I have this 401k and BlackRock's apparently managing some of it, like, what should I be doing with it? Should I trust you guys with it, or, should I be investing it elsewhere or something along those lines? And that's one of the times when it starts to bring it to fruition. You realize you're like, this isn't just about getting a good job. This isn't just about, making sure that I have a bike that I can go cycle on the weekends with, or spending money on a Friday night with my friends. What we're about, what BlackRock's about, what Advent Partners are about, is about helping folks like my dad, helping folks like his first engineer to go and achieve financial well-being and to go and reach their financial goals. We think there's great opportunity out there for all of you to be able to go and do just that. There's great opportunity within equities, there's great opportunity within fixed income, and there's a way and there's a path to go and help ensure that financial well-being is within all of ours reach. So whenever I'm giving these presentations, I love coming out here, talking with folks like yourself, because when I look around, I think towards my dad, I think towards, folks that, I went on the boat and helped work with, and thinking of those folks and be able to go and help them achieve financial well-being. So thank you all very much. I really appreciate it.
Thanks, Nick. Again, I want to thank Charlie and Nick for coming here and sharing with us their expertise. Like I mentioned earlier, Nick is going to be relocating to Hong Kong here in the next month or so. So we were part of his farewell tour, at least on the East Coast. And we're thrilled to have them. Just a couple things to point out. You probably have been seeing information about that one big beautiful bill and some of the tax impacts. And so we're still digesting some of that and how that's going to impact all of you. So stay tuned as we meet here in the coming months. We'll be talking about specific ways that may be impacting you as an investor, as well as there's some unique things related to making some of the 2017 tax cuts permanent, as well as some estate tax implications and things like that. So not a big news flash there. I know you've seen a lot of news about that. There's a lot of talk and confusion over what actually is in there, and we're still trying to digest that ourselves. So stay tuned there. But again, I appreciate the time that you've spent with us this morning, and I hope you have a great day. Thanks a lot.